Thank you, Phil. And as if that wasn't enough already, there are still a number of other issues and other policy initiatives that are threatening to move cost of government day later into the year. And another one we took a look at is a lesser known but no less important issue that has to do with competitiveness. Brian Ellis of the American Shareholders.org is here to discuss the issue of tax deferral and the foreign tax credit. And essentially the Obama administration's plans to tinker with or do away with both, essentially. From there, we'll move right into an area that touches on the hotly contested issue this summer, healthcare. And specifically, we're going to be looking at one of the trial balloons that has been floated as a potential funding mechanism for a healthcare overhaul, the value-added tax, or VAT, and the dangers it presents. So, Ryan?
Okay, thanks a lot. My name is Brian Ellis. I'm Executive Director of a group called AmericanShareholders.org. American Shareholders was founded in 2000 to represent the majority of adults and 2/3 of voters who own shares of stocks, bonds, mutual funds, ETFs, all the other financial instruments that are out there. Too often those people are forgotten, people that actually invest, save, and produce a lot of the capital that's needed in order to fund what's going on in America. What I wanted to talk about today was something that is an extremely important part of Cost of Government Day, but often gets overlooked, and that's the international angle. This angle is especially important to shareholders because so many companies now are multinational companies. And when Congress is looking for pay-fors, they're looking for tax increases, the first thing they do is they turn to Subpart F of the tax code, they turn to a lot of the ways that they can raise taxes on companies that do business overseas, U.S. companies that have overseas operations, because frankly it's confusing, not a lot of people understand it, and it's easily demagogued, and it's usually used as a populist argument against companies. What we have up here is an interesting question of what would happen under a worst-case scenario. What you've seen in the last several years has been kind of a Swiss cheese or rifle shot approach, where Charlie Rangel from the Ways and Means Committee, or the Obama administration in their budget, or Max Baucus from the Finance Committee have done little teeny changes that they propose as far as tax increases for international. And what we said is, okay, well, they're doing kind of small ball with this, but we all know where they're going. What they want to have is full, all-on double taxation of international corporate profits. So what we did was sort of phase this in over several different steps as to what they would have. First of all, deferral. This is the one that you see most of the time. They want to prevent companies from being able to defer paying U.S. taxes on some of their foreign profits. If you got rid of deferral entirely, you would add a full day to cost of government day. The other thing we have in the code that helps prevent a double taxation of U.S. companies' corporate profits internationally is a foreign tax credit, which is very complex to administer. There's different baskets, and it's one of those complex areas of the tax code. So if you got rid of the foreign tax credit, that would be another day that you would have to add to cost of government day. And if you did both, obviously, if you just had no deferral of income, meaning that when a company, a U.S. company, earns overseas income, they have to pay international taxes on that income, of course, because that's the country they earn it in. And they also have to pay U.S. taxes on that. And if you didn't give them an ability to take a foreign tax credit for that, that would add 2 full days to the cost of government day. The reason this is important is because it doesn't have anything to do, so much to do with shareholders as much as it has to do with jobs. The U.S. is one of the only major industrialized countries left in the world that taxes its international income of its own taxpayers this way. Most countries have a system that's known as territoriality. Under territoriality, if you are an Irish company and you sell a widget in France, you pay corporate income tax in France, and Ireland doesn't bother you anymore. However, if you're a United States company that sells that widget in France, you've got to pay corporate income taxes in France, and then at some point when you bring that money back over here, you're also going to have to pay some tax to the United States government. That's what's called a worldwide tax system. A worldwide tax system does a couple of things. One, it encourages U.S. companies with an international subsidiary to become an international company with a U.S. subsidiary. If you ever wondered why Daimler Chrysler isn't called Chrysler Daimler, that's why. Because it's much cheaper to have a German company with a U.S. subsidiary. If you move to a territorial system, it would actually harmonize with what the rest of the world does. The tax treatment of it would be fair, it would be transparent, everybody would know how you do it. We had a very interesting experiment in territoriality back in 2005 when the American Jobs Creation Act was passed. What happened was, for 1 year and 1 year only, we told companies that if you have these foreign earnings that you've had sitting in overseas bank accounts and you want to bring them back to the United States, we're not going to let you bring it back for free, but we'll let you bring it back, and you only have to pay effectively a 5.25% repatriation tax rate, which in many cases would be much lower than what they would have to pay. What we found was that $318 billion came back that 1 year that was sitting in foreign bank accounts or sitting earning interest and creating jobs overseas, was brought back just that 1 year to the United States. And that money was used to create jobs, to buy equipment, to return capital to shareholders. It was a very effective, very powerful tool. And effectively what it did was it put a territoriality regime in place almost for that 1 year. And we could do that again today. We could bring back several $100 billion. Again, it's been built up overseas. We could bring that back again today. Now, if you talk to people about the problem with international taxation, a lot of people, especially domestic manufacturers and others that are really bearing the brunt of this, will suggest a value-added tax. They'll say, well, maybe we should just swap out our corporate income tax regime entirely and swap it out for a value-added tax like they have in Europe. Well, we personally think that's very problematic. First, in general, why is that problematic? First, a VAT, a value-added tax, is like a sales tax. It is a tax on what you buy. You go to the store, you pay the VAT. If you're in Europe or another country that has a VAT. The difference is that it's very different than a sales tax that you or I would know if we were to leave here today and go buy a Snickers bar downstairs or a Diet Coke downstairs. If we were to go buy a Diet Coke downstairs and it costs $1, and there's a 7% sales tax in the District of Columbia, we would pay $1.07 when we go to buy that Diet Coke. That's what's known as an extrinsically expressed tax rate. It's transparent, it's clear, everyone knows what tax they pay. A VAT works just the opposite. A VAT is what's known as an intrinsically expressed tax rate. So if you go to Europe and you buy that same bottle of Diet Coke, they might charge you €2 for that. Somewhere inside of that €2 is the VAT that you're paying. You have no idea how much it is unless you go to investigate it, and there's usually different rates and different carve-outs. So it's very opaque, and as a result, it's a tax that politicians have found that they can very easily raise. When VAT started out in Europe in the late 1960s, they were around a 5% VAT rate. Now the average VAT rate in the EU is 20%, and in fact there's a minimum 15% VAT rate just to get into the European Union. So it's a tax that has gone up over time. Furthermore, it's a tax that, as it's gone up in Europe, other taxes haven't gone down. Other taxes have gone up too. So as more money went to the government thought of more ideas to spend it on, and they decided to raise other taxes to pay for those good ideas. So, two ideas that you often hear to pay for a VAT, or two ideas to do with VAT money, rather, that you hear about in the current context of the United States is, how about health care, or how about these unfunded liabilities in Social Security and Medicare? Well, we ran the numbers on this. If we were to pay for HR 3200 with a VAT, and we're assuming that the annual cost of the Democrat health care bill is going to be about $300 billion a year. We get that from looking at the later out years of the bill. The last year of the 10-year CBO score is $230 billion. We kind of rounded that up because we think CBO is a little bit underestimating the subsidy that would be needed for the public option. But when that bill is fully phased in, it'll cost, we think, between $250 and $300 billion a year in order to implement. If you assume a European VAT base, which exempts things like real estate purchases and certain politically popular purchases and exports, things that you would normally expect to exclude, you can see the impact of cost of government here. Cost of government would go from August 12th to August 21st. So that would be a 9-day increase in the cost of government if we were to pay for this government health care scheme with a VAT. Well, what would happen if we wanted to fill in the hole in the unfunded liabilities in Social Security and Medicare? This is something that many have proposed as a painless way to solve the entitlement problem. We just take all the unfunded liabilities of Social Security and Medicare, which are in the trillions over the next 75 years. What would happen to cost of government day if we implemented a VAT in order to pay for that? Well, you can see there the cost of government would go up by 13 days if we were to fill that in. And one of the interesting things I think you'll find in the report here in the VAT section is we actually plot out year by year what the VAT rate would have to be each year of the next 75 years to fill in the Social Security and Medicare deficit that year. And you'll see it starts out very little. It's a fraction of a percent, 0.2%. And it goes up almost to a 13% VAT. So when people talk about filling in Social Security and Medicare with VAT, what they're really talking about is a 13% VAT by the end of that window. So, wanted to point out the international side of this, what the deferral regime has to do with that, and then how that ties in to healthcare reform and potential reform of the entitlements. Thanks.